Hey guys, here we go with lecture number 2 being recorded. You can see there's a lot of slides here. There's 74 slides. So in the interest of my sanity and your sanity, I'm going to go through these fairly quick. There's a couple big points I really want to hit with this one. The other stuff I'm going to go pretty quick. Some things that I would explain in some pretty good detail in class, I'm really just going to cut to the chase and tell you what the point is, and then encourage you to explore the depth on those points if you want to question the things that I'm saying, which you're absolutely free to do and I encourage. So rather than trying to spend a lot of time and difficulty in this format justifying some of the things I'm saying, I'm just going to tell you what I think the right answer is and encourage you to go look into it so we can get through this in a reasonable time. Okay? So here we go. Today we're going to talk about these topics here. Some of them are going to go really fast and some a little slower. The stuff right at the end, the ultimate buy and hold, I'm super excited to share with you. And it's going to involve you looking at some tables that I have up on OWL in PDF form and me trying to talk you through them. Okay? So here we go. First, MERs. Last lecture, we talked about fees, right? MERs on mutual funds and ETFs, and we saw that mutual funds typically have high fees or higher fees, sometimes very high fees, and ETFs have lower fees, and we definitely like lower fees. So just to drive home this point again, in the last bunch of years, there were some instances where companies found that their own employees were suing the company they work for because the company they worked for put high MER funds into their pension plan. Okay? So let's think about this for a second. If you can see on this slide, companies like Boeing, for example, the employees of Boeing sued Boeing because Boeing put expensive high MER funds in the Boeing pension plan. And the employees are like, why are you putting these crappy high fee funds into a pension plan when there were cheaper options? So you can see Lockheed Martin's employees sued them, Boeing's employees sued them, Walmart's employees sued them, et cetera, and there's been some settlements. But that's not the best part. Look at some of the other companies that were sued. Dun, 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 dun. Fidelity, Ameriprise Financial, and Mass Mutual. Okay, and you can read on the following slides the stats, but just look at these companies. Let's take Fidelity. So think about this for a second. Fidelity sells mutual funds. The people that work for Fidelity sell mutual funds. That's what they do. You could walk it off the street as an investor into a Fidelity office and say, hey, would you sell me some investments? Would you help me set up my investment accounts? And Fidelity would say, sure. Here are some mutual funds that we think you should buy because the employees are happily going to sell you the high fee funds because the employees will get bigger bonuses and make more money, just like at the banks, right? So Fidelity set up a pension plan for Fidelity employees, and what did they put in it? Fidelity mutual funds. And the employees sued them and said, how dare you put these crappy high fee Fidelity mutual funds in our pension plan when cheaper options exist? Oh, the irony. I hope you understand what I'm trying to tell you. And that happened at Ameriprise and Mass Mutual. It would be like people that work at a restaurant suing the restaurant for making those employees eat at the restaurant. It's insane. So the nerve of these employees at Fidelity to sue Fidelity for making them use Fidelity funds when they would happily sell them to you. Anyway, here we go. So you can read about those. Too funny. Okay, so if you saw my announcement on OWL, I can't play these videos for you now and record them and then put them up on YouTube because YouTube already slapped me with a copyright violation because they did that for the last lecture with the Warren Buffett video. I find it ironic considering that these videos are on YouTube and I'm putting my video on YouTube, but whatever. So I'm not going to click onto these videos. If you want to laugh, this one's hilarious. It's John Oliver, who I think is just a stitch, and he's talking about the company he works for at the program trying to set up what they call a 401k plan. It's basically like a pension plan in the US. That's what they call them down there. And he goes on this huge rant about fees. It's hilarious. Now, The first part, the first 6 minutes and 20 seconds, are talking about other things which are equally funny. If you want to get to the part about the investing fees, you can skip ahead to 6:20. Be warned, for everybody though, there's a couple of curse words in the video, so if that will offend you, you have been warned. Please don't watch it and then send in complaint letters to my boss, okay? So it's pretty funny. Next, I won't click on that link either, but you see there's an article listed at the bottom, and it's talking about a contest where they let professional fund managers pick stocks, and then they let a cat pick stocks, and the cat was winning. And this kind of contest has been done throughout the ages, and it's funny. They have literally let people throw darts at a dartboard where they put the stock pages from the old newspapers up, and all the company names are listed there, and people just whip darts, and whatever company name the dart hits is what they put into the made-up portfolio, and they put that made-up portfolio against actual portfolios from actual people that run mutual funds and so forth, and more often than not, the dart throwing will win. And they've done it where they've let a monkey pick stocks by touching the paper, and they just pick whatever stock the monkey touches, and the monkey wins. And I think they did one once where they let a pigeon walk around on a newspaper, and whatever companies the pigeon pooped on, they would pick those companies, and the pigeon wins. Obviously, they don't win all the time, but they win more often than not, which reinforces the real research we saw in the last lecture, where actively managed mutual funds can't beat the index. And the reason is, of course, their fees and stuff. So anyway, funny article if you want to read that. And in that video, John Oliver talks about this cat winning the stock picking. That's why I included the article. Okay, now I want to switch. I'm going to talk about REITs. So a couple of lectures ago, we talked about different asset classes, right? We talked about stocks, bonds, commodities, gold, stuff like this, cash. And I said one of the asset classes that we could invest in, of course, is real estate. Now, I think real estate belongs in your portfolio, in your stock portfolio, in your RSPs, in your TFSAs. It doesn't have to. If you didn't include it, I don't think that's necessarily a bad thing, but I think there's probably a place for some. Keep in mind, we might want to be cautious about how much we put in, because our homes are already a big part of our net worth. So we already have some money tied up in real estate as it is. Now, if you're going to invest in real estate inside your portfolios, how do you do it? I think the easiest way to do that is through this particular product called a REIT. So REIT stands for, as you can see here, Real Estate Investment Trust. Okay, so it's a trust, but it acts like a business that invests and owns in various types of real estate. So I've mentioned some examples in class. You could invest in, meaning buy shares in, a REIT that runs nursing homes or apartment buildings or warehouses or storage lockers or whatever. Okay, so there's over 1,100 REITs in the US alone, so lots to choose from. Okay, and here's some examples here. Again, in the interest of time, if you'll forgive me, I'm not going to click on these. I really encourage you to. These are just 3 that I picked at random, and you can see they all invest in different types of real estate. So if you wanted, say the second one here in the middle looked really interesting to you, and you can look at the historical returns as a possible guess as to how well they may do in the future, and you could think, wow, this is a really good one. I may invest in it. And you could do that. But investing in an individual REIT is like investing in an individual company. And there's risks with that, of course, right? So I'm sure you will not be surprised, really suggest that if you want to add real estate and REITs to your portfolio, which I think, again, you should do it with a index of REITs, meaning buy all the REITs or most of the REITs, right? It's kind of like my buy all the boats idea when I talk about stocks. Let's buy the whole Canadian stock market, the whole US stock market, etc. If we're going to buy REITs, let's just buy them all. Let's buy all the apartment building REITs, all the warehouse REITs, all the industrial land REITs, etc., right? So that way we don't have to try to guess which ones are good and which ones are bad and so forth. Let's just buy them all. And we know that, and I showed this a couple lectures ago, even though we don't have as much data on REITs as we do, say, the US stock market, we see that it returns about the same amount as the S&P 500, but it goes up and down differently than the S&P 500. So you get some diversification benefits there. Sometimes when the stock market is down, REITs can be up a little bit and vice versa. So you get some advantages there. Okay. So there's two here that I list. And again, forgive me, in the interest of time, I'm just going to let you guys click through these. VNQ is one. And then there's another one down here from Vanguard Canada. So both of these are exchange traded funds that invest in a whole bunch of REITs. You know what? I'm going to click on one. Let's do this one. This is a really popular one. So this is a US REIT. Okay, again, here's the ticker symbol. Oh, I can't draw on this, sorry. VNQ, you can see there. So product summary. This invests in stocks issued by REITs. The goal is to closely track the return of the US investable market real estate. Okay, and you can see on the right, it has a 0.12% expense ratio, so pretty darn cheap. Okay, and if we go down here, we can see, if you look on the right side here, number of stocks, 184. So this particular ETF invests in 184 different REITs. They're going to be big REITs, so you're getting tons of diversification. And if you look on the left here, look at all the different kinds of REITs it invests in. Healthcare REITs, hotel REITs, industrial REITs, office, real estate operating companies, et cetera, residential, specialized, whatever that means. So you're getting a huge diversification of REITs. So this is a great way to add, for example, US real estate to your portfolio. This would be a super easy way to do it, super cheap, really low MERs. And let's see if we can find the returns. Let's go up here, price and performance. We're looking for a 10-year average. There you go. 10-year average for this particular investment, 11.27. So it's done pretty well. That's annualized, of course, on an average annual return basis. So pretty good. Again, easy, very simple way to add real estate to your portfolio. Now, if you click on the other one, which I won't do, if you click on oh goodness, if you click on this here, this is a Canadian ETF. It invests in a bunch of Canadian REITs. There aren't that many, but it invests in them for you. And you'll notice that the returns, big surprise, aren't as good as the US. So if you wanted to add real estate to your portfolio and you only wanted to use this one, the US one, and not the Canadian one, I'm not sure that's a bad idea. Okay, I think that would be okay. All right, next, hedge funds. I'm going to do this pretty quick because again, in the interest of time, and this isn't a super important topic, way more fun to talk about in class and maybe ask some exam questions, but since we're not doing that, I can do this a little quickly. Hedge funds, I just bring up in this course, not because I want you to invest in them, it's because I probably don't want you to invest in them, to be honest, and I want to bring them up because you're probably going to hear about them at some point if you haven't already, and it's good to talk about the risks associated with them and why you probably want to steer clear. Okay. Now that being said, full disclosure, I had a colleague who invested in a hedge fund, and I'll explain what that means in a second. And she showed me their annual returns, which again, it's a regulated market. It's not like it was a fraud. It was real returns that she showed me, and the returns were awesome. I mean, just awesome, just amazing returns. But that's so rare. Okay, she got so lucky. She picked a good one, and it did great. Okay, so what's a hedge fund? They're called alternative investments. Okay, you can see that here, alternative investments. They're pooled funds, meaning they work kind of like a mutual fund and ETF, where a bunch of people get together and they put this money into the hedge fund, and then the hedge fund pretty much does anything they want to try to earn money. Now, each hedge fund will tell you that they have a particular strategy that they like to follow. I'm not going to try to explain any of them here because they're kind of complicated and beyond the scope of the course, right? But basically, the people that run the hedge fund can do just about anything they want to try to make money. And you are hoping that the people running your hedge fund are like the best of the best of the best, the smartest of the smart of the smart. And they're going to take your money and make fabulous returns. And my colleague that had invested, she found one of those, and they were amazing investors, and they did a great job and made her lots and lots of money. Okay, these things are available to what we call accredited investors. Okay, so only special people can invest. There's usually a high minimum requirement we'll see in a second. These things are not liquid, so illiquid, meaning it's hard to get your money out because they don't want people pulling money out all the time like you would say a mutual fund. They want the money to stay in there so they can keep it invested. Okay, so they only let you withdraw at certain times. Now, what's an accredited investor? Let's talk about this. In Canada, the rules, generally speaking, are, and now in fairness, I haven't looked them up for this year, so they may have changed slightly, but as of last year anyway, the rules say that a non-accredited investor, so somebody who is not accredited, can only invest in a hedge fund by investing at least $150,000. Wow. But accredited investors can invest smaller amounts, like say 25 grand, maybe even less. So that's a crazy rule. So the special investors, the accredited investors, can invest in these hedge funds with just a little bit of money. But the non-accredited or the non-special investors, they have to invest a huge amount of money. And why do they do that? They have this rule in place to stop the non-accredited investors from getting into hedge funds. The rule is to protect us from ourselves and to stop us from investing in hedge funds unless we're willing to risk something crazy like 150 grand. And that's a lot of money. Okay, that's a lot of money. I've got 150 grand I could invest. There is no way I would invest in a hedge fund because I know I'm probably going to lose it. Okay, so that's why these rules are in place. So to become an accredited investor, there's a couple of tests. Okay, test number one, an individual who, alone or together with a spouse, owns financial assets, so stocks, bonds, etc., worth more than $1 million, but net of related reliability. So say you have $1 million in financial assets, or an individual who, alone or together with a spouse, has net assets of at least $5 million. I don't know why I put this one in numbers and this one in words, but whatever I did. So you either have to have financial assets of more than $1 million or net assets of at least 5. So what's the difference? This number here could include real estate and maybe small businesses, your own, I'm not sure. Okay, so I guess technically, before the market went down a couple of weeks ago, my wife and I actually surpassed this, so I guess we technically would be accredited investors. Good to know. So they set the threshold high, so that's test one. Or you have to be an individual whose net income before tax exceeds $200,000 in both of the last 2 years, and you expect to maintain that level of income this year, so you have to make a lot of money per year. Or an individual whose net income before taxes, combine that with a spouse, makes at least $300,000 a year for the last 2 years, and you are expected to continue. So the test basically says, test one, you already have a lot of wealth, or you make a lot of money every year. And let's be honest, these levels of income for Canada, those are very high levels of income. So why? Why did they put this test in place? They put this test in place to say, if you want to be accredited and invest in special things like hedge funds, you either have to already be wealthy or somewhat wealthy or make a lot of money. And the reason they do that is because they know you're probably going to lose your investment in the hedge fund, and they don't want it to cripple you. So if you're going to invest in the hedge fund and you lose 100 grand, you already had a net worth between 1 million and 5 million. Losing 100 grand is not going to be the end of the world. Or if you say lost 100,000 in a hedge fund, that's, it's bad, but you make so much income that you can recover from that in life. So accredited investors are rich investors, and they get to make investments in special things, and the government lets them because they can absorb the risk or absorb the loss. Non-accredited investors, people that don't have a lot of wealth and don't have a lot of income, they try to create barriers like this to stop them from going to hedge funds because they know they're probably going to lose their money too. Okay? All right, so that's the accredited investor thing. So what do hedge funds do? They were originally designed to do well when the market was going up and to protect your capital when the market was going down. So times like right now, hedge funds traditionally should be doing pretty well. And for those of you that study finance, it's in the name, right? Hedge. It's a hedge fund. It's to hedge or mitigate or reduce your risk when the markets are going down. That's what hedge funds were designed to do. These days, hedge funds have kind of morphed into these super actively managed, super risky investments that invest in all kinds of crazy things. And they're not necessarily worried about protecting your money on the downside anymore. A lot of them do, but not all of them anymore. Okay? So here's an example of a couple of guys. George Soros, I'm pretty sure, is this guy, and Michael Steinhardt is this guy, ran a hedge fund and posted returns of 30% per year on average in the 80s and 90s. Holy cow. Holy cow. Which is why George Soros is one of the richest people on earth, and he's famous, and every time he speaks, people listen to him. So, I mean, 30% returns for almost 2 decades, that's unbelievable, right? So here were two guys, two rare individuals who figured out how to make a lot of money, and they were brilliant, and it worked. And if you had invested money in their hedge fund, man, you were laughing, okay? Sadly, this was not the one my colleague had invested in, okay? Now, hedge funds charge huge fees. These genius people like this don't work for free. The common fee in hedge funds is this 2 and 20 concept, though they're starting to get a bit cheaper these days. 2 and 20 means they charge you 2% a year. That's the MER, 2% a year, and 20% of the profits over a certain level. So the fund will say something like, if we make, I'm just making this up, if we make over $10 million in profits, every dollar above that, we get to keep 20% of it. It's an ingenious business plan. For those of you that are listening to this and you study finance, go start a hedge fund and invest rich idiots to invest money with you. Because you get to make crazy, wild gambles and bets, doing all sorts of crazy things, derivatives, tradings, all sorts of stuff, right? With other people's money. And if it blows up and it goes to zero, well, that was other people's money. But if it works, you get to keep 20% of the profits. It's amazing. It's one of the most beautiful business plans going. Okay. What do we not like about hedge funds? They often fail miserably. Okay, you can see the stats here. I won't read it to you. Almost all of them, or at least a huge percentage of them, eventually go bankrupt because they're making wild bets and taking crazy gambles, again, with other people's money. So a lot of these things blow up. Okay, so if you're in a hedge fund, you might hit a home run or you might strike out, and it just depends if you get lucky. So here's a historical chart. It's a little old. It ends in 2015. That shows hedge fund returns compared to the S&P 500. Okay, so in 2000, 2001, and 2002, hedge funds were doing great. Okay, in 2003, 2004, 5, 6, and 7, they weren't doing great compared to the S&P 500. They weren't doing awful, but they weren't doing great. And then in 2008, they did great again. And then after that, they were doing terrible. Why? Because again, most hedge funds traditionally were set up to do well when the market's going down. Well, the market was going down here. This is the tech bubble. So the stock market wasn't doing well. So the S&P didn't do great, but the hedge funds did okay. 2008, this is the financial crisis, obviously, so the hedge funds did okay. But in these other years, like especially here, where the stock market's doing fantastic, the hedge funds weren't doing really well. And I'll remind you, if you can think back to the last lecture, if you made it through those videos, I talked about that bet Warren Buffett made. Who did he make the bet with? The guy that made the bet was a hedge fund manager. And the hedge fund manager picked a basket of hedge funds to compete against Warren Buffett. Warren Buffett picked the S&P 500. They started the bet here, and Warren Buffett crushed them. The S&P 500 did way better than the hedge funds, and you can kind of see why. Okay? So here's another chart, basically showing the same thing. A couple more years here, you can see in 16 and 17, the S&P 500 was still doing better. Okay? So if you want to invest in hedge funds, let's be honest, you've got to get some wealth together first to become an accredited investor. Then you've got to be willing to maybe have a bunch of your money blow up. Most of these things fail. And it's crazy, you know, if you go back a few slides where it talks about how many of these things fail, you can see here it says how the overall number did not decrease, however, meaning there's still as many hedge funds today as there were before because hope springs eternal and new funds are constantly being launched. And it's crazy to think, why would rich people keep firing their money into these things knowing most of the time they blow up? It's because their ego wants them to be in the next fund with guys like this. They want to be able to brag to all their friends that they got, money into this fund and they've made millions and millions. So I think it's just my personal opinion for rich people, they like gambling in hedge funds because it makes a heck of a story when it pays off. Okay. Now, if you want to invest in hedge fund-like investments and you're not accredited, the markets have created this kind of investment called liquid alternatives, which are ETFs that are trying to replicate what some hedge funds do. I want to be very clear. I'm not really recommending this at all. I do not own any of these in my portfolio. If you want to, please put this kind of investment in your sandbox. Okay, make it your speculative part of the 10% of your portfolio, whatever the case may be. I'm really not endorsing this, but if you want to start investigating it for fun, go ahead, and there's an article here you can start reading about it. Okay? All right, now let's talk about brokerage accounts. Actually, I'm going to take a quick break. I will be right back.